Taxes are an inevitable part of life for most people, but for billionaires, they often seem more like an optional suggestion. While the average worker has their wages taxed before they even receive their paycheck, the ultra-wealthy use a variety of legal loopholes, offshore accounts, and financial strategies to minimize or even eliminate their tax liabilities. It's not about breaking the law. It's about knowing how to navigate it in ways that benefit those with vast resources. One of the most common methods billionaires use to avoid paying taxes is by keeping their wealth in assets rather than income. Ordinary people earn salaries, which are taxed at a high rate, but billionaires often structure their earnings differently. Instead of taking a direct salary, they invest their money in stocks, real estate, and businesses. When their assets increase in value, they are not taxed until they are sold. Even then, capital gains tax rates are much lower than income tax rates, meaning they pay significantly less tax than someone earning the same amount through wages. Another tactic is borrowing against assets. Instead of selling stocks and triggering capital gains tax, billionaires take out loans using their stocks or other assets as collateral. Because loans are not considered taxable income, they can access huge amounts of money without officially earning anything on paper. This allows them to maintain lavish lifestyles while avoiding taxes legally. Offshore accounts and shell companies are also key tools in tax avoidance. Billionaires often set up accounts in tax havens such as the Cayman Islands, Switzerland, or the British Virgin Islands, where banking secrecy laws and low tax rates protect their wealth. By funneling money through offshore entities, they can reduce taxable income, defer taxes, or even hide wealth from tax authorities. Multinational corporations owned by billionaires use similar strategies by shifting profits to subsidiaries in low-tax countries, a process known as transfer pricing. Charitable foundations provide another way for billionaires to shield their wealth. When they donate money or assets to their own foundations, they receive massive tax deductions. While this might seem like philanthropy, many of these foundations are structured in ways that allow the billionaire to maintain control over the funds while avoiding taxes. Some even use these foundations to invest in businesses they own, effectively keeping the money within their own financial ecosystem while appearing to engage in charity. Real estate loopholes are another significant way billionaires minimize taxes. Through strategies like depreciation deductions, they can claim losses on properties that are actually increasing in value. By continually refinancing properties and reinvesting, they can delay taxes indefinitely. The 1031 exchange, a provision in U.S. tax law, allows real estate investors to sell a property and reinvest the proceeds into another property without paying capital gains tax. This can be repeated indefinitely, allowing wealth to grow tax-free. Pass-through entities such as LLCs and S corporations provide additional tax advantages. Instead of paying corporate tax, income from these entities passes through to the owner's personal tax return, often at a lower rate. By structuring businesses in this way, billionaires can avoid the higher tax rates applied to large corporations while benefiting from deductions available to small business owners. Another significant tax avoidance strategy is carried interest, a loophole used primarily by hedge fund managers and private equity investors. Carried interest is a share of profits from an investment fund that is taxed at the lower capital gains rate instead of regular income tax. Since billionaires in finance often receive compensation in the form of carried interest rather than salary, they can significantly reduce their tax bills. Trusts are also commonly used by billionaires to shield wealth from taxes. By placing assets into a trust, they can pass wealth to heirs while minimizing estate taxes. Complex structures such as grantor-retained annuity trusts, GRATs, allow them to transfer wealth to family members without triggering large tax bills. These trusts can also be used to manage and protect assets in ways that limit exposure to creditors or tax authorities. Political influence plays a role in maintaining these tax advantages. Billionaires and their corporations spend millions lobbying for favorable tax policies and legal loopholes. They fund political campaigns, think tanks, and advocacy groups to ensure that laws and regulations continue to benefit the ultra-wealthy. Many tax laws are written with complex provisions that are difficult for the average person to understand but are expertly navigated by billionaire tax attorneys and financial planners. While all of these strategies are legal, they raise ethical questions about fairness in the tax system. The average worker has little choice but to pay taxes on their wages, while billionaires can manipulate financial laws to their advantage. Some argue that closing these loopholes and enforcing stricter tax regulations would create a more equitable system. However, any attempt to change tax laws is met with strong resistance from those who benefit the most from them. Governments around the world have attempted to crack down on tax avoidance through measures such as global minimum tax agreements, stricter offshore banking regulations, and increased scrutiny of corporate tax structures. However, the ultra-wealthy often adapt quickly, finding new ways to preserve their financial advantages. As long as the laws provide opportunities for tax minimization, billionaires will continue to exploit them,